Hello everyone, myself Aditya Kurne. Today I will be presenting the topic convolution and cross correlation in happy trading. And we will see the signal and system perspective of this topic. And at the end, we also will apply what we have learned on the real time stock market. Like we will predict what will be the market trend in the future and all that. So what is high frequency trading? Like everyone must have heard the term like trading. So high frequency trading is just the trading occurs between the time frame of 9:15 to 3:30. So like we have to make trades and all that within the time period. So it's we get a very low time period to judge trade whether the market trend will go up or down, and then in that limited short time we have to execute a trade whether we will buy a stock or sell a stock. So like it's a very low time frame work. So that's why it is called high frequency trading. This is like the stock market trend looks like. This is the candlestick pattern of a stock I have taken. So you can see there are a lot of uncertainties in it. Like it is going upward, then suddenly it goes downward, up, down, and it will continue. Yeah, there is not much similarities. We can track like a pattern or something. So like this candlestick act as a signal or an input. So it contains a lot of information. So we can utilize this to predict the future trends and all that. So it is like a non-linear system. We can see as it is lot of randomness and uncertainty in it. And also it is time variant. Like it evolves all the time, and it is not like repeat itself and on a particular interval of time and all that. Whereas it is dynamic in nature. So like its future price may depend on the present or the past input. So we can use these properties to affect the future one. So let's refresh some of our classroom topics. What is convolution? So we will use the convolution uh, to predict the future prices of the stock or the trend of the market. It will go like it is a bullish or bearish one. So this is a convolution for the convolution of two discrete time signals, whereas xn is the input and hn is a transfer function. So we convolute xn over hn and we get the our desired output. So we have studied this in class. So I will not tell about it much. You already know. So xn, like we will take a input signal as a stock prices, and we will take a transfer function as a window frame. We will see that further, and then we can get a signal of the market. Similarly, what is cross correlation? Cross correlation, just like if there are two signals, xt and yt, and one signal is lagging behind the another by a certain time, then we can find the relation uh, by how much it is lagging and all that. So like you can see if it is y of t is lagging by t amount, then we can judge it. You will see a visualization, so it will make a more clear. So like this is input signal and this is transfer function. So when we take a integral or we say convolute, we get a cross correlation as this. And whereas we take a inverse of this with respect to y-axis, we take a convolution. You can see this is the convolution. And how can we use this convolution in high frequency trading? So when we convolute the data, like this is the stock market, we have seen a lot of uncertainties, the spikes, then a lot of noise we have. So we can convolute by convolution, we can make the trend more shorten. Like you can see, we have convoluted over a time frame. Like we have taken a time frame and taken the average of stock prices with transfer function, which it is moving average. We will see in the both side what is moving average and all that. So it is convoluted and making the market more specific. Like it will be easier to judge the future price as it is moving down the curve more clearly. So like it is like a low pass filter. It removes the noise and all that high frequency. So by which this helps the trader to focus on actual trend rather than focusing on the noise and all that detail. So we can make a more accurate prediction. So we have seen the visualization of moving average in the previous slide. So like it does the curve. So what it does, it is just like the convolution of the price data with the rectangular curve. So we take a rectangular frame and take averages of all the prices and we predict the future price. Like suppose this is a real-time market and we want to how we calculate the moving averages. We take a time frame, suppose like this. So if we have to judge the yes, I'm just- okay. So if we have to judge the original price of this candle that is out of the frame, the above one, we will take the average of all the previous lines, and that will be the original price of that this candlestick pattern, what we call as moving average. So if we want to calculate of above candlestick pattern, we will use the frame and we calculate the averages, uh, average prices of the previous candlestick pattern. So that's how we calculate the moving average. So in this way, by using the moving average, we can judge the market rate. Like it smooths the actual uh, uncertainty data over a proper line. So like we can judge the market more accurately. If a moving average is going upward, then we can say that the market is bullish. Whereas the moving average is going downward, we call it as a bearish one. You can see this is the bearish one, this is bullish one. Similarly, what is cross correlation? Suppose we have two stocks. Like we trade in forex trading. Suppose a dollar is there and an Indian rupee is there. If there are similarities between the two stock, like dollar is if dollar falls, then Indian rupees also fall. But there is certain time lag. So we can find this time lag and trade the Indian rupees more accurately. If the dollar is falling, and then after the tea time, the we know that Indian rupees also fine. So we will find what is cross correlation and how that we have seen the correlation. Suppose this is one signal and this is another signal. We find take a cross correlation like a convolution and predict the trend, like how will it perform a particular signal and what is the time lag and all that. So let's deep dive into the real market and do trading and perform, apply some of our knowledge of convolution to a real time market and make some money and take the future trend of the market. So let's do it. So now let's apply our knowledge on the stock market. So this is a live stock market. Suppose this is the stock of Zomato and it is going live. So I have made a fine script of for a moving average. I have taken the length of a frame of 20 days, so it will calculate the moving average of 20 days, and it is convoluting. It is taking a moving average and will predict the curve. And I have taken a buy condition. If the moving average crosses the candlestick pattern and goes upward, then we'll give a buy signal. Whereas it will go downward, it will give a sell signal. So let's apply this script on the chart. I will copy it. So I will add this to the chart. So yeah, you can see it is giving the signal. So here we get a buy signal, and immediately after that, the market goes up, 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 up. You can see it is going a lot up, up, up. It has gone from 263 to 289. So that's approximately 10%. So in intraday, 10% means you get 5x margin. So you can earn like 50%. So if you invest in this one trade, like 1 lakh rupees, you would have earned 50,000 in just if you have got correct this signal. So yeah, we are getting a pretty accurate signal. Similarly, we got the sell signal here, and after that, the market goes down. Yeah, from this frame also we can get a lot of potential of earning. So whereas it is not always accurate, like not 100% accurate. Accurate. Like here we get a sell signal and market fall, but not to a lot of amount. So like we didn't earn a lot in this trade. So like there are maybe not 100% accurate, but yeah, it can basically help us to get more confident whether we will have to take a trade on this point of time or we will not have to. It makes us sure, give us a clarity whether we will take a trade or not. So it can help us a lot. So yeah, that's how we perform the trade. So yeah, this is how we perform or build the system. Like we take an input of stock price and then we build a system and we got the output of buy and sell signal. So we apply the basic concept of signal and system to predict the future prices. So in conclusion, we can say that the signal and system plays a crucial role in financial market analysis and predicting the stock market and help us to get detect the market what we say market data or market trend to get faster and more precise decision. So yeah, that's what all from my side. And thank you for watching. Thanks.